All right, guys. Happy Sunday, March 22nd, 2026. We're coming off a week that will be in the history books. We saw a violent breakdown in the yields and the single worst week for gold since the 1980s. Today, we're dissecting the charts a little bit to see if this correction is a regime shift. And we'll take a look at the dollar, the 10-year yield, Bitcoin, gold silver ratio, um, and see what the market is doing. So we got Rich here, of course, and he's going to be helping out with analyzing some of the risk assets like SPY and Bitcoin. But yeah, let's break into how you doing, Rich.
Yeah, I'm well. I'm well. Welcome everybody to another edition of Relative Edge.
Yes, sir. Yes, sir.
Excited to show for you this week and give guidance and see what we are doing and what we see and what we are looking at for the future days ahead.
Yes, sir. Yeah, so last week, let's dive into the charts now. In the top left hand panel, you can see the 10-year yield. We broke out of this range. Right now, I'm going to pull up the daily chart, but we were converging. We were getting lower highs and higher lows, and you're echoing a little bit there, Rich. Um, but yeah, so we were in a downward channel and within a downward channel, and we look like we're breaking out of this pennant now. So look at this. We're getting lower highs, higher lows. Then we broke out of that channel. Broke out of that pennant. We're still in the channel. Now we.
Are you sharing your screen?
I'll share my screen with you. Sorry. All right. Can you see that? Yep.
Yeah, now I see your screen. Yep.
Okay, perfect. Yeah, so we were trading in this downward channel, within a downward channel, and we broke out the bottom of this pennant. We were getting some higher lows and lower highs, and then we were riding up against the bottom of this pennant, and we broke out not only of this downward channel that has been in place since January 16th, 2025, but yeah, so now we're up here on the rates. This is not looking good. As you guys know, this is the 10-year basis. No, it's basically the overnight lending rate for banks. When this rate goes up, everything gets more expensive. In terms of money gets more expensive. So if you want to if you want to buy a house, if you want to buy a car, if you want to get a loan, this is the interest rate that's gonna be what everything's gonna be based on. So right now, interest rates are going up, so money is getting more expensive. And you can see here, the dollar I have in the top right hand corner. Was in this is in this upward channel since the 27th of the year. And last week, if I zoom in, this is a daily chart, but I'm going to zoom to the 4-hour chart. So last week we were trading down in this downward channel within the upward channel, and we're still in the channel, so we don't know what's going to happen here. But I do want to note one important thing, that this level, the $100 level, or more specifically 99.5 on the dollar, is really important because there's always very strong support or resistance at that level, and we closed actually above that level. So we tried getting lower on Friday and bounced up, and that's putting pressure on the silver and gold. Let's see what gold's doing right now. Gold's down now to 4,400. Yeah, so it's a little bit lower. It looks like silver's bouncing right now around 67, but gap down. Let's see if it comes back up or if it goes down. And the SPY is also down. Bitcoin's down, and a really big driver right now is going to be oil. So oil's flat. Oil opened up flat this week. So yeah, I want to give it over to Rich so he can talk a little bit about what he's seeing in the markets. So Rich, what you got? You want to share your screen here?
Yeah, absolutely. Thank you. All right, let's share my screen. And
Yeah, last week was very interesting in the markets. Gold had its worst week and since the 80s, which is crazy because it's funny because oil just had its best week since the 80s, like 2 weeks ago. Now gold has its worst week since the 80s. In a time where um, you would think safe havens are an asset people are looking towards, but not necessarily here. So right here is going to be Rich's screen, and yeah, get into it.
Yeah, so what you're seeing here is the S&P 500, which gives you a barometer of what every sector is doing, and they're not doing well, including as Jabbar is saying, even gold and metals. So what I have here is a comparison chart in addition to bearish divergence, which shows the strength of the buying and selling, and the comparison from 2025 to 2026 with regards to the start of the year in January to April for 2025 and the start of the year of 2026, January to where we are now as of the last trading day, which was March 20th, 2026 at 4 p.m. And what you see here is a possible repeat of last year. Now, the supporting evidence is geopolitical things that is happening in in Iran, where we have the war. So when the markets are nervous, they sell off, and it can actually escalate even further, especially when positions are liquidated. I've actually heard news of private equity firms being liquidated, and when they liquidate, they have to sell their assets. It's a margin call. When they're on margin, they leverage things. So one of the best performing, as Jabari was saying, for quite some time has been gold and silver. So when big companies and private equity firms get margin called, they have to sell. So that's one of the reasons, yeah, pressure on that. So when you see a comparison between, back to the SPY chart, between last year and what we're coming into, as you see last year from its all-time high, it went down 21%. Now, for your information, any drop in a market or overall market, 20% or more is a bear market. And as you see here, we dropped into the bear market and sprung back in the same month, April 2025. Now, this doesn't have to necessarily happen in April of 2026, but it's more likely than not that we're going to drop. But are we going to spring back because of the geopolitical things that are happening in the world right now? Or we can say it's more likely based on evidence in the past. And in addition to, as you see with the RSI, the bearish divergence, and what that is, as the market has an uptrend, which it's still in, the strength of the buys, which is the green, is actually going in the opposite directions. It's trending downwards. As you see, the market is trending upwards. So with that evidence, the bearish divergence, geopolitical things that are going on, and a lot of liquidations in addition to commodities, which people usually run to, they're going down to also. With that evidence, it's more likely we're going to have a repeat of April and go down at least another 20%. Not to say that in the beginning we won't, on a daily chart or a weekly chart, that we go up a little bit, but then turn downwards. So that's for the monthly SPY chart comparison. Mm-hmm. Let's go to Bitcoin. Now, Bitcoin is still considered a risk asset compared to the S&P 500/equities. So even right now, we're showing a chart. This is a fixed chart as of, I think, 20 minutes ago, and it's actually gone down even further. This is actual fixed chart, so I can actually look at the Bitcoin. We can switch back to that live. It's down 1,000 points. So it was probably at, right now, it was 20 minutes ago, it was at 67,844. It went down to 66,000. But what we see here is some liquidity, also bearish divergence in the comparison from 2025 to 2026. And as I marked out, as you saw in the chart before, I marked out April 2026. So what we have here is, now, let me explain a little bit about the leverage liquidity. This is where the market makers set the price. And where you have leverage long and leverage short liquidity, it's like a magnet. We're right in between where you got leverage short, leverage long liquidity. So even if we bounce up and take out the leverage short liquidity on the upside and go to maybe in the 80,000s, be sure because of the evidence of the SPY, it's going to cause pressure for Bitcoin to go to the downside and take out the leverage long liquidities. Many um, professional traders actually echo that the bottom of the market is not in, and we're looking at possibly at least a bare minimum of 50,000. And where I have this blue line here, if I can zoom in a little bit, this is a low of this consolidation here,
Mm.
and that is at $49,000 even, which would take out all this leverage long liquidity. So in addition to this addressing the bearish divergence, as you see here, when the market is trending upwards, which is a steep incline here and a decline here on the RSI, as you see, when it started to roll over and top out, the trend started to decrease its incline, and as that of which in effect for two things cyclically every October, every 4 years in October. So in 2022, that happened when in October that it reached all time high, and it rolls over and goes into a bear market. And as we see here is a repeat, and this has happened for the past 3 or 4 cycles that this has happened according to historical data. So
And just for the people out there, can you define what leverage long and leverage short liquidity are?
yeah, so the leverage short liquidity, meaning that they are leveraging, for example, if you have a position that you have $1,000 and you decide to say, okay, I want to have the power of $20,000. I'll leverage it 20 times. So they leverage it. They leverage it that amount of time. So when it hits that leverage liquidity area, the actual market makers actually make more money when they liquidate a position.
Gotcha.
And yeah, and either side. So when you go short, meaning you anticipate that the market is going to go lower, and the leverage longs you're anticipating that it's going to go higher. So if you have a position that is equal that you have a cash value in fiat of $10,000, and you want it to go and you want to have a position that's worth $100,000, you leverage it 10 times.
There you go. Nice.
Yeah.
All right. And then what other chart did you have in there? Is that
Yeah.
an oil chart next?
So I do want to mention oil because currently oil is affecting the value of the dollar because I believe in the 1950s, if I'm not mistaken, they made a deal with Iran and other countries, Iran, Venezuela, and I believe there's another country. I believe
Saudi Arabia.
Say again.
Saudi Arabia.
Saudi Arabia, that to trade oil, trade in U.S. dollars, and by doing that, they will also buy bonds in the U.S. market in the U.S. dollars.
Mm-hmm.
So that is actually affecting the price of the dollar. So this particular chart where we have it in U.S. oil, as you can see, that was taken at 550 p.m. So that wasn't too long ago. That's
Yeah,
about
it's
40,
relatively flat
40
off
minutes
the
ago.
open.
It gets very volatile when the futures open up, and as you can see in this particular chart, it's consolidating sideways, but starting to turn up. But I did see that when the futures open up at 6 p.m., um, which was 17 minutes ago, it actually spikes up to 104 and also spiked down. Usually that's to imbalance things, take out take out longs, take out shorts, to also, as you saw in the price charts, individuals being leveraged where the market makers that set the price make more money, because it's not only us making money or losing money, or making money. Let's be positive about it, but also those that are setting the price. They're trying to make the most amount of money.
Hmm.
So also, yeah.
Yeah, and I just looked up the petrodollar on Gemini, so I can give like a quick rundown.
Yep.
But it says the petrodollar system refers to the global practice of pricing and trading crude oil exclusively in U.S. dollars. Established in the 1970s through a deal between U.S. and Saudi Arabia, it guaranteed that oil exporting nations would receive payment in dollars in exchange for American military protection. This arrangement forces nations worldwide to maintain large reserves of U.S. currency to purchase energy, effectively cementing the dollar as the world's primary reserve currency, and the recycling of these profits back to the U.S. Treasury bonds and bank provides the U.S. with significant liquidity and lower borrowing cost. Today, the system faces new challenges as some nations begin exploring alternative currencies for energy settlements to reduce their reliance on the American financial system. And this is my ad lib. Of course, when that happens, that's when bombs start dropping.
Right. I wonder if I can. No, I can't right now. Wanted to see if I can show what the oil is doing right now. Is, as you can,
Coming down, look at that.
yep, you see that spike up to 104.
Mm,
That trend line that I drew, it actually is acting as support. So currently, right now, is 98. So
but
when
it's
it opened up at 6 o'clock, it spiked up from, let's see, open was $98 all the way to 104, spiked down to $97, and it's currently at 98.
it's testing that midpoint. It just broke the midpoint. It's testing that 4 hour uptrend on the RSI.
Yep, yep. It's going. If I go to the 4 hour to get a clean shot
Okay,
at
so we're
it,
still up there pretty high. Still pretty overbought.
yeah. If we look at it purely on the RSI, it's still in the uptrend, but however, it's still above the midpoint.
Yes. And for those out there, RSI is a relative strength index. It shows you where the momentum is in a stock. And typically there's a midpoint, and I'm getting a little bit of feedback on your end from you, Rich. Um, but
Yeah. Uh,
when it's above the midpoint, that is when um, that is when the stock is more bullish, and when it's below the midpoint, that's when it's more bearish.
Yeah, relative to where it is, because right now it's above the midpoint. So when it crosses, it's a caution sign.
Mm-hmm.
It's definitely a caution sign, because as if you look back, it crosses the midpoint and bounce back up. If it holds below, and especially breaking this trend line, there's further downside, which is good, which is actually a good thing for equities, commodities, gold, silver, itself. That'll be a good that'll be a good thing. Yeah, because there's
Yeah, I
always
mean, you
some
see
stocks going up.
silver bouncing a little bit, gold bouncing a little bit. So
Yeah,
we'll see what happens.
yeah,
Yeah. Anyway, want to get into the relative charts. That's why we call this relative edge, because we're not only measuring asset prices based on our currency, which is the U.S. dollar, but we want to measure the relative value against other assets. So we're going to start out with the asset Dow Jones Industrial Average. Dow Jones Industrial Average versus gold is in a macro downtrend, right? And this is a daily chart right here. So each one of these candles is a day. So yeah, we're in a downward channel here. We just look like we opened today, just now, at the top of this channel. So that means gold should start to bounce versus the Dow Jones if we are to stay in this downward channel that we've been in since July of 2024. So we've been in this downward channel for a while. This is an inverse cup and handle where this is the cup, the first little loop here. We test the breakout point, and then we have another handle, which is where we're at right now. I drew this in here this week because I just wanted to visualize what the cup and handle would look like, the inverse cup and handle. So inverse cup and handle is a bearish pattern, cup and handle is a bullish pattern. So I think that the Dow is going to underperform gold, and that we're going to bounce off the top of this support in this downward channel and move down. So what I'm thinking is going to happen here is I think we get rejected from this downward channel, which it looks like it's happening right now. And the first place we got to break is 9. We got to break 9 here, and then once we break 9, that gives us the opportunity to come down a little further. And I don't know why it's not letting me see this, but basically, I think that we're gonna come down to the bottom of this um, channel and test the bottom side of this channel. So let me move into gold and silver because I'm a little behind here. Gold and silver was trading in this bearish pattern. This is a bear flag, which is a down move followed by sideways consolidation. Consolidation is when price moves between a specific range. So this range is a slight upward bullish channel. So we're going up in this bullish channel, and we broke out of this little diamond pattern, and now we're testing the top of this, which was resistance. And from my previous videos, you can go back and see that 66, 65 is a really strong level for the gold and silver ratio. There's a lot of support, a lot of resistance at that area. And typically when we break through that area of 65, usually we stay in that area for a few years, if not decades. So look back at the chart and do your own analysis there. So what my guess is that we won't break above 65. I think we still will break down from here. But I mean, we're coming pretty close to it. And I think at the top of, if we do break to 65, that means we're headed to the upward side of this channel. So you see, look, we go to this side of the channel, to the resistance side of the channel, to the support side of the channel. If we break through 65, which is an extremely strong resistance, we're going to push up to the upward side of this channel, which is relatively around 75, maybe 78. And then from there, we'll see what happens. But I still think that this ratio is going to break down. I think maybe this by next week. Looks like this converges on March 26th, which would be the end of this week. I still think we're going to break down. So now let's go into the silver versus silver miners. Ignore this one bar because the market is not open. But last week, we broke back into this upward bullish channel. So this is silver versus silver miners, meaning when this is in an uptrend, that means silver is outperforming silver miners. We know that silver miners require silver to rally. So when the silver versus silver miners pair chart is in an uptrend, that means that silver is in a downtrend. That means if you want silver to go up, if you want silver miners to go up, you need silver miners to outperform silver. And this is a key week because this was the first week. If I go to the weekly chart, we had broke it. We were trading in this upward channel. We broke down, and then last week, 2 weeks ago, we closed inside of it, and last week we confirmed, which is very bearish for this, and silver in the short term. So I want to see if we get an engulfing bar pattern to negate this pattern this week, and see if we break back down. But if not, all bets are off in the short term. Obviously, long term, silver is a great asset, but you want to make some money on the short term. And then one chart I do want to look at too. Load time is at 28 minutes. This is the risk curve for me. And Rich, I want to get your thoughts on this. But what I did here is I multiplied the 10-year yield and the U.S. dollar, and I divided by a ratio, the golden ratio, to basically get a ratio. So as you know, the 10-year yield and the U.S. dollar, as those go up, it adds pressure to risk assets like S&P 500, gold, silver. Every market is affected by the U.S. dollar strength because it's the world reserve currency, and then our interest rates because that determines the rate of inflation, or it's one of the determining things. And if you go to the RSI, the relative strength index, if you look on, this is the weekly chart. Check this out, Rich. We're in a downward channel on the RSI, and we're at the top side of this channel, meaning that interest rates and the dollar should go down if this trend continues. Every time we get to the top of this bearish channel, we get rejected, meaning that the dollar comes down and interest rates come down. So if this stays true, which is the same, this has been in case since 2022, or actually March 2022, we should come down soon in the next few weeks, which would line up with the what the Fed is saying about cutting this year. But obviously, the war kind of throws a curveball into this situation because we don't know what's going to happen in Iran. But we heard a lot of threats from Trump this week, this weekend specifically, saying that if Iran does not agree to some type of ceasefire in the next 48 hours, um, then there will be significant casualties, that the U.S. will bomb their energy sites. So that's one thing to look for this week. Obviously, none of us want this war to escalate, and it's hurting everybody. But we have to be careful about what we're trading, and kind of take these opportunities. But yeah, my prediction for this week is that the dollar will get some pressure in terms of coming down. I think the Fed will step in. Um, I think, and I do have some like important support and resistance levels I want to name real quick. Um, but yeah, so for the dollar, um, or so for interest rates, the resistance is going to be around 4.5. Support is going to be around, and this is the top left hand corner. Support is going to be around 4.35. The dollar, um, supports at 99.5, which is like right here. So if we can break below this, this is bullish for metals. Um, for gold, I'm gonna pull up gold right here, which it looks like gold's it gapped down, but it's bouncing right now. Support is 4,300. We didn't even get there yet. Resistance is gonna be 4,600. So yeah, those are just some levels to look at right now. And then for crude oil, we got support at 90 and resistance at 100. So we already got rejected at 100. So let's see if we break through 90 this week. But yeah, we got
Yeah.
an exciting week. And yeah, Rich, what do you think?
Yeah, expect volatility. I would say when it comes to the 10-year yield, and there are a number of them, different 20 years and so on and so forth, and the dollar, I would say that is a couple of things where what's pulling it back and forth is oil, but then the oil is driven by news. So even though we're doing technical analysis and seeing where things and predictions, news can trump everything. So if you have a inverted cup and handle, and all of a sudden um, the war is over, you're going to see a spike in gold and silver, and you're going to see a drop in the dollar, and you're going to see a drop in oil. But evidence is showing that this war that was predicted to be 2 to 4 weeks, that doesn't make any sense. Also, as in the past, when it comes to Trump, and if you look at the news, even with the tariffs, he says something outrageous. He's trying to calm the markets and saying the war is going to be over soon. His recent posts and something that you shared with me, Jabari, is that that within 48 hours, he needs a decision, but he's trying to bring Iran to the negotiation table, and they're not interested in negotiating, especially with the escalation. Not only that they have is doing bombings, they're actually sending troops like boots on the ground. So that's an additional escalation, which shows further evidence that this is not going to be over in any time soon. Let's just say it's not going to be over this week.
Yeah, yeah.
As we prepare for this week.
Yeah,
Yeah.
exactly. So those are some important things to remember. The key things to remember is right now, oil, the 10-year yield, interest rates, and the dollar are trending together. They're positively correlated. So when we see those dip, when we see those come down, then the stock market and gold and silver are going to start to get some relief. Maybe we might get a relief bounce. So keep that in mind for this week. And yeah, good luck trading. None of this is financial advice. We're just pointing out observations that we find. But yeah, hopefully this war can end soon. Nobody likes that. People are dying, but at the same time, we have to protect our assets and our money and make sure that we're not hurt by this war financially. So, and if anything, that we benefit and we learn from it and protect ourselves. So, yeah, that's all I got.
Yeah, absolutely. Our hearts go out to those that are being affected by the wars and the families that are grieving right now. And our hearts go out to them. And yeah, and we just gave you the relative edge.
Yes.
And protect, as I say in some of my posts, for risk management, protect your assets at all times.
Yes, sir. Yes, sir. So you guys have a great week. We'll get back to it next week on Sunday, and you guys have a good one. All right. Bye, guys.